Chairman Bernanke, I wonder if you can just comment on what are the primary factors that you are monitoring as to gauge the economic risks of your current policies. In other words, given that the effectiveness of Federal Reserve policy has been at least somewhat muted over the last few years by a strong deleveraging cycle, how important do you consider the expansion of bank lending or the results of the Fed's own Senior Loan Officer Opinion Survey as a gauge of future inflation? And also, what other factors, other than just pure inflation measures, do you look at as potential precursors to an expansion of economic risks due to these policies?
Well, we've seen a number of things which are suggestive that the effects of the financial crisis are being mitigated to some extent. As you mentioned, consumers are deleveraging, their debt burdens and their interest burdens are going down, and their balance sheets are healthier than they've been. A smaller number of people are underwater in their mortgages, for example. Banks are much healthier. In our regulatory role, we've been doing these stress tests, and we found that the largest banks have now roughly doubled the amount of capital they had 4 years ago. And as that survey you mentioned indicates, their willingness to lend is improving in many areas, not in all. There's still issues in mortgage lending, but credit availability is improving. So a number of factors related to the financial crisis do seem to be moderating, and that's hopeful for further progress in the real economy. On inflation, we use econometric models. We look at market data. We look at commodity prices, commodity futures prices. We simply don't see at this point much sign of inflation. In fact, inflation is a little bit on the low side historically. And if you look at market indicators, the very fact that the United States can borrow at 30 years at under 3% is indicative of the idea that investors are not anticipating a major inflation problem in this country. So we are very attentive to that. That is half our mandate. But at the moment, inflation, if anything, seems a little bit on the low side.
Yeah. And knowing that's the case, why do you think businesses aren't investing so much in the economy? Interest rates are at really low rates, especially long-term interest rates. And so I don't talk to any businesses, again, in Minnesota that are saying interest rates need to be lower for us to invest. But at what point, can you comment like whether it's the tax increases? You talked about the payroll tax in your testimony expiring. You talked about the tax increases maybe at the end of the year having an effect. But at what point are the tax hikes, do you believe, on high earners or as a part of the new taxes associated with the implementation of the Affordable Care Act? And in Minnesota, Senator Klobuchar and I, we both see the effects of the medical device tax. At what point do you think those taxes are having an impact now in terms of a drag on the economy?
Well, firms have been investing in hiring in a way that is consistent with the overall slow pace of growth. I mean, they're not seeing the rapid growth that would induce them to expand capacity quickly. Given the amount of growth that they see, they have been investing, and employment growth, as unsatisfactory as it is probably a little stronger than you would have guessed, given how much GDP growth there is, how much output growth there is. Firms don't respond very strongly to interest rates directly in their investment decisions. A lot of literature suggests that. But they do respond to final demand, how many orders they have. And so indirectly, the way monetary policy stimulates capital investment is by generating more consumer demand through the fact that lower interest rates do affect consumer spending or raise house prices or other asset prices. And we've been seeing the last few reports on consumer spending have been surprisingly strong. And we've seen improvement. Just the other day, we saw a very substantial improvement in consumer optimism. So that's where the monetary policy's best channel for affecting investment. If firms see more demand coming in the door, then they will expand capital and labor.
And do you see a drag on the economy with some of the tax hikes that have happened at the end of the year?
I mentioned a list of things, including tax increases, elimination of the payroll tax cut, other things. I'm not pronouncing on the desirability or of any one of those specific policies. I'm just saying, taking them all together, they have the effect of being a drag on economic growth, and perhaps more than necessary.
Right. I yield back, Mr. Chairman.
Thank you. Senator Coates is recognized.